What if I told you that quantum computing could change the future of Bitcoin as we know it?
Exactly, and today we'll dive into how experts predict these changes will unfold.
Welcome to Financial Insights in Minutes, where we unravel complex financial topics into bite-sized, actionable insights.
You won't want to miss out on the key tactics for maximizing your wealth potential.
Plus, we have predictions for the real estate market from Glenn Kelman, insights from McElroy about wealth building, and much more.
Stay tuned as we unfold the strategies that could define your financial future.
This content is for educational purposes only and shouldn't be considered investment advice. In this episode, we explore the intriguing intersection of quantum computing and Bitcoin with Adam Back, CEO of Blockstream, and a pivotal figure in Bitcoin's history.
Adam discusses the realities of quantum capabilities and the actual risks they present to Bitcoin and cryptography.
The central thesis is that while quantum computing could pose threats to Bitcoin in the future, current advancements are not yet a practical concern.
Adam illustrates that Bitcoin remains secure against any short-term quantum developments, but the community must remain vigilant.
Adam elaborates on how current quantum computers are far from being capable of breaking encryption and factoring large numbers.
Experts assert that we are still likely decades away from a quantum computer that could threaten cryptography.
The concern is that a sufficiently advanced quantum computer could break Bitcoin's cryptographic security model.
However, currently, there's no quantum computer capable of executing these threats at a practical level.
Adam stresses the importance of preparing Bitcoin for a quantum future without creating panic.
He mentions that the Bitcoin community is considering how to introduce quantum-resistant signatures without disrupting existing systems.
The timeline for practical quantum threats remains a matter of debate, but the consensus is clear: Bitcoin must prepare.
Significant advancements in quantum computing could arrive sooner than we expect. Hence, early preparation is key.
The dialogue underscores the need for the Bitcoin community, including investors and developers, to remain proactive in addressing emerging threats.
As we look ahead, fostering collaboration and innovation will be key to navigating the challenges posed by quantum computing.
Today, we're analyzing the first trading day of 2025 with Matt from Trade Brigade.
Matt explains how early market behavior can set the tone for the year, especially for stocks like Tesla and Apple.
Matt notes that the S&P futures opened with uncertainty, indicating cautious trades.
He shares concerns about Tesla's delivery numbers negatively impacting investor sentiment.
Matt highlights competitive pressures faced by Apple in the Chinese market as a point of contention.
Matt emphasizes the manufacturing PMI as crucial for market volatility.
He indicates that positive job numbers could allow the Fed to maintain the current interest rates longer.
Tesla's challenges in delivery performance hint at potential demand issues.
Matt points out how Apple might experience fallout from reduced sales in China.
What strategies does Matt suggest for navigating current market conditions?
He stresses the importance of patience and having defined trading plans.
Matt foresees inflation stabilizing if the Fed takes earnest actions.
He cautions that ongoing supply chain problems could keep inflation unchecked. To sum up, Matt encourages traders to stay alert and ready for market fluctuations.
Recognizing key economic indicators is essential for informed trading. Today we dive into the recent financial turmoil as analyzed by Jeff Snyder, an independent financial analyst known for his insights on global markets.
Jeff emphasizes that the world's financial scene has been in upheaval since late November 2024. His thesis revolves around a sudden shift that has led to significant currency collapses and market chaos.
Jeff Snyder's core thesis points to significant instability in the market since late November, exacerbated by rising concerns over trade wars and macroeconomic difficulties.
He illustrates how currencies like Brazil's real and India's rupee have faced dramatic declines since then, highlighting a pressing need for action.
Jeff highlights how the Trump election sparked some short-term market optimism, particularly visible in the 5-year swap market, which saw a significant recovery.
But despite this, longer-term trends remain bearish, indicating that the market expected challenges ahead regardless of the political shift.
Jeff predicts a critical crossroads for the markets: stabilization or further decline, largely hinging on central bank actions.
He suggests that if proactive measures aren't taken soon, we could see more turmoil well into 2025.
Jeff's analysis offers vital lessons. Adapting to economic shifts is essential for both individuals and policymakers.
In a world where market conditions can change overnight, preparedness and awareness are key for navigating these turbulent waters.
Today, we're diving into the analysis presented by the host from the Technical Traders. He broke down recent movements in the stock market, especially around year-end profit-taking.
Right. The host noted that many traders are pulling profits as part of a strategy called tax harvesting, especially with the markets showing signs of hesitation.
The host shares concerns regarding potential corrections in the market, predicting significant declines of 33 to 55%.
He's cautious, mentioning signs of a major topping phase as more traders adopt bullish sentiment.
The host pointed out recent spikes in panic selling, which historically signify that the market may be due for a rebound.
That's fascinating. It reflects the notion that excessive panic could drive prices up later.
He describes the market as being in a risky topping phase, particularly visible in the tech-heavy sectors.
Exactly. If tech stocks start to falter, it could trigger a wider market downturn.
He makes historical comparisons to the 2008 financial crisis, suggesting potential parallels in the current market behavior.
That definitely adds weight to his argument, especially with how patterns seem to repeat.
The host predicts January's performance could set the tone for the entire year.
So if January sees declines, that's a serious red flag for investors.
The overall takeaway is that navigating this uncertain market requires solid strategies and adaptability.
Absolutely. It's about being proactive rather than reactive to market trends.
Today's discussion focuses on Ken McElroy's insights into how wealthy individuals think about money.
Ken argues that true wealth is more about one's financial mindset than just their income.
Ken highlights that wealth is fundamentally about mindset and the actions one takes.
He suggests that affluent individuals focus on acquiring income-producing assets rather than merely saving. Ken stresses that investing in income-generating assets, particularly real estate, is crucial to wealth.
So wealth comes from purchasing items that generate income rather than liabilities.
Exactly. A rich mindset seeks investments that cover lifestyle costs.
Ken explains that wealthy individuals view most money as debt, leveraging it for growth.
So unlike poor habits of accruing bad debt, the wealthy manage good debt for appreciation?
Exactly. They use low-interest debt smartly to grow their asset base.
Ken claims that understanding taxes is essential for preserving wealth.
So taxes are a major expense, and wealthy individuals use strategies to reduce this.
Absolutely. They apply deductions like depreciation to lower their tax burden.
Ken emphasizes the necessity of legal structures to protect personal wealth.
So using LLCs means that legal actions can't directly target personal assets.
Exactly. It's a prudent way for the wealthy to protect their financial interests.
Lastly, Ken asserts that engaging in financial management is essential for the wealthy.
So the rich maintain an active role with their money instead of relying solely on advisors.
That's right. They stay informed to better maximize their investment outcomes.
Ken foresees that financial illiteracy could exacerbate the wealth divide.
And many could be left behind if they fail to adapt.
Exactly. Knowledge is critical for the future prosperity of society.
Ken's insights reinforce that achieving real wealth begins with a change in mindset.
And recognizing that effective money management leads to improved financial success.
Today, we dive into the housing market with Glenn Kelman, CEO of Redfin. He brings fresh insights on what to expect in 2025.
Glenn highlights that home prices will continue to rise, but with forces like high mortgage rates, it's a balancing act for buyers.
Kelman predicts a 4% rise in home prices for 2025, yet buyers face challenges with mortgage rates around 7%.
He identified the inventory crisis as a significant hurdle that will contribute to ongoing price increases.
Glenn notes the high mortgage rate is a critical challenge for buyers, creating a tough entrance into the market.
It's a real catch-22, wanting to buy but struggling with affordability challenges.
Glenn suggests mortgage rates will likely stay high, with the Fed remaining cautious about rate cuts due to inflation.
The uncertainty surrounding inflation complicates predictions for when rates might decline.
Kelman concludes that the real estate market is evolving, especially as Gen Z reshapes the concept of home.
Potential homebuyers are encouraged to focus on love for their future home, irrespective of market trends.
That was quite an enlightening discussion, wasn't it?
Absolutely, we had a fantastic lineup of experts sharing their insights.
Glenn Kelman painted a clear picture of the housing market with his forecast, but the challenge of high mortgage rates really struck a chord.
And Ken McElroy, emphasizing the wealth-building mindset, highlighted that financial management is key, not just income.
Right. Then we heard from the technical traders who warned about market corrections due to investor complacency.
And Jeff Snyder tied it all back to the macroeconomic chaos, hinting at those sharp currency collapses lingering from late last year.
Each guest brought unique views, but the agreements on the need for strategic financial planning were clear.
True, but they also had differing opinions. Kelman mentions a housing recovery timing that differs from Snyder's concerns on broader economic health.
If you found this analysis as insightful as I did, be sure to hit that like button and subscribe.
Your support helps us keep this critical discussion going and ensures you don't miss out on our future content.
Stay tuned for our next deep dive into market dynamics. You won't want to miss it.